All right, everyone, thank you for joining us for another Chicago Blockchain Real Estate Collective meetup. These have been a ton of fun. I think this is our third now, and we've picked up some really great individuals to come and speak, some just momentum in general. Again, we're talking about real estate, we're talking about blockchain and how blockchain technology is really going to become the industry standard as the years go by. At least that's what we believe, and based on our research, we're really excited about it. So one surprise for you today, if you read the fine notes in the description, you'll notice that Jordan Steck is also going to be presenting today. Our headliner is Tyler Harttraft of Bull Blockchain Law, and we're really excited for Tyler's presentation. But before we dive into what Tyler has to share with us today, Jordan Steck, a founding member of Liberty Real Estate Fund, is joining us here, and he's going to give us a high-level overview of security token offerings and what it looks like behind the scenes on what we're working on, and as well as provide a lot of information and insight for you if you're looking to do the same thing. Jordan has just been nothing but spectacular from the times that I have had to gotten a chance to work with him, especially in regards to what we're doing with Liberty Real Estate Fund. So Jordan, if you could just give a little bit more background on yourself and go ahead and dive into presenting what you've got. And then I should also say, if you guys do have questions for Jordan along the way, go to the chat box. That's where we're gonna facilitate the Q&A, and we will have about 5 minutes of Q&A for Jordan. So here we go. Jordan, the microphone is yours.
Thanks, Adam. Thanks everybody for having me. First, before I'll get started, I'll say that, Adam, these last few calls, I've been really jealous of your backdrop. Here I'm in my black box, and you've got your nice plant and your photo. So thanks for the inspiration. But so my name is Jordan Steck. Let me give you a little bit of a background about where I've come from in commercial real estate and the reasons that I really wanted to get into the beautiful thing that is blockchain. I started in commercial real estate doing asset management, operations, and acquisitions for a ton of different asset classes, from multifamily to retail to hospitality, you name it. And I sat down and I decided to, like some of us do, think that I was a day trader. And an issue I ran into with that was, I would sell off my shares, and all of a sudden I couldn't take my money out of it. And I had to wait, 1, 2, 3, 4, 5 days to get true access to that capital. And in comes blockchain and the things that come in with that. And I said to myself, well, wait a minute, what if I can take the beautiful thing that is commercial real estate and the investment characteristics that come with that, and combine it with blockchain technology to create something that's new and something that would provide some sort of, more liquidity where it hasn't been before. And Adam, I'm going to share my screen here. Okay, can everybody see that?
You're good.
Great. Okay. So first off, and I won't step on Tyler's toes too much. He's a true professional and fantastic to work with, especially on the legal side of security token offerings. Now, when I go through this, now I'm going to take it from a real high level, but I wouldn't look at this with a comb and think about it from a high level. What really is a security token offering as compared to your traditional real estate fund or your initial public offering? So a security token offering, essentially what it is, you're taking your real estate, whether it be your single asset or your massive fund or your medium-sized fund, whatever it might be, and essentially what you're doing is you're digitizing the shares or the rights to the equity, much like what it works with in an IPO, except it comes with a lot more benefits because of this blockchain technology that's running behind it. And so it comes with 9 kind of key sets or key benefits. The first being the capital raise. With this type of technology, what it does for you really is it gives you a high degree of cost savings, not by cutting out intermediaries, specifically, but more on the side of really being able to efficiently do this in a timely and more effective manner. So what that also does is that you're able to raise this capital, within 1 to 3 months, where sometimes, if you do an IPO or traditional raise, it might take you 9 months, 12 months, or 16 months, whatever that set number is. Now, when I was kind of introducing myself and telling you a little bit of story about, how I got into the blockchain space, I talked about, those having physical access to those shares. One of the real core features, one of the most exciting features of this type of product center is the access to your capital and the settlement time. When you sell a share, whether it be to a person you know or on an exchange, you truly will have physical access to that capital within 1 to 3 minutes, which is amazing. Because if you're in a cash crunch and you say, wait a minute, I see this beautiful investment on the right side, but I've got all of my money tied up in the left side, and it's going to take me 5 trading days to get that money, I might have missed my chance. So it gives you that option to do that and trade out of that within minutes. Not only that, it also has compliance and governance. Now, don't get too tied up really on the compliance and governance. It's kind of wordy. But what this really is, within the token itself, it's built in with something called a smart contract. And it's exactly how it sounds. It's a contract, but it's smart. And what it does is it just verifies the transfer between parties with programmed governance and sophisticated economic rights. Meaning, well, wait a minute, this is automatically going to tell me, does this person qualify to purchase this token? Does he have enough money to, transfer that? Whatever that might be, it does it from a smart basis and very quickly. And that's where one of the pieces comes in with the settlement time, because a lot of times with, an IPO or when you're trading shares on the market, there's a lot of intermediaries that have to go on to check things from a legal perspective. But what if you could use a smart contract to do that automatically? And it turns out, to our surprise, you can do that. Another thing is transparency. And I think this is a big, big thing in not only in investing, but in real estate. It's tough to really get a true investment where you have transparency on a real-time basis to see what is going on in the market, right? We have these real estate investment trusts, again, which are these publicly traded real estate funds, and they release their income statements, or their balance sheets, whichever term you want to use, on a quarterly basis. And sometimes it's really difficult to get real-time true data and transparency. Not only that, you're getting transparency because the blockchain itself is just that. It records these transactions so that you can see them in real time. Now, another thing is capital formation. It's digital, it's scalable, and you have the ability to raise funds at a higher market capitalization. And what I mean by that really is it's scalable to a level where if I'm doing an IPO or I'm raising a fund in the United States, I'm limited to people who are within, 1, the United States, and 2, have the ability to get onto these applications or these broker dealers like E-Trade to trade those funds. Now, wait a minute, what if we can use a technology that's globally scalable, where somebody in, all over the world can easily be able to, put money into your fund, whether it's in Australia, whether it's in New Zealand, whether it's in the UK, whether it's in Europe, it doesn't matter. It's globally scalable and it reaches every part of the world. We also have fractional ownership, and that's fractional ownership of equity and debt of either your single real estate investment or the fund itself. And what's really unique about this is, when you trade a share, you are only allowed to trade 1 share or 2 share, effectively a whole number. And another thing with that is, our currency is tied to 2 decimal places, right? 1 penny, 2 penny. The real interesting thing about this is that the blockchain allows you to fractionalize your shares to 8 decimal places. So you can sell as much as you want, whether it's 1.002, to some other person, while still keeping the rest to yourself. So it's super fractional. Jordan. And that also comes in to say, wait a minute, that's also globally scalable, because there are people who aren't putting in a ton of money into the market, right? Whether it's risk threshold or that's what they're comfortable with putting in. Now they can do that on a fractional basis instead of getting just 1 share.
And Jordan, excuse me for a second too. I just want to make sure we have enough time to get get Tyler's presentation in here too. Is there any way we can expedite this? And then also, it looks like you do have some questions. So guys, if you do have questions for Jordan too, we'll make sure we get his email address in the chat box as well. Sorry.
Yeah, sure. No, not a problem.
Okay.
So the last thing I'll say then here, and we can talk, we can set up a call and talk about cap tables and funding options and whatever that is. But, the biggest thing is the liquidity piece. When you use this type of technology, it's not that you can trade this during the trading hours of 9:30 to 4. You can do this 24/7, 365. Not only on exchanges, also known as alternative trading systems, but also on a peer-to-peer format where you can say to somebody, hey, you know what? I think you'll like this fund, and if you want to, you can have my shares, and you can do that on that level as well. So, that's the high level of the security token offering, and I'll kind of let Tyler take it off from here.
Thank you, Jordan. And guys, Jordan, I should say, please post your email address in the chat box. Guys, if you want to have a conversation with Jordan right here as well, feel free to use the chat box. We are going to move it over here to our headliner, Tyler Harttraft, who has a really great presentation lined up for you. He made it especially for us, for today, for right now. So you guys are the first ones who are going to get to see this. A little background on Tyler. He advises businesses on key legal issues concerning corporate matters, capital market regulations, and fundraising compliance, as well as intellectual property protection and licensing. He's got, just a really great bio here, along with a few other things. He publishes articles. He analyzed a few recent SEC enforcement actions and other regulatory developments pertaining to cryptocurrency and blockchain companies. Tyler, if you would also like to just fill in any of the gaps there in regards to your background that I haven't touched on, I'd appreciate it. And then take it away.
Yeah, absolutely. Thank you guys for having me. It's great to be here talking with you all about this. Jordan, thank you very much for laying the foundation. Make my job a lot easier by diving into all of those issues, because, the more we talk about this, the more we realize that blockchain and the technologies associated with it are really like peeling back an onion. You mentioned one thing, and all of a sudden you're diving into different concepts that you really need to define just to understand the basics. So definitely appreciate the primer. And yeah, guys, can everyone see my screen? First of all, Adam, is that displaying okay? Okay.
You're good to go.
Yeah, thank you for the intro, Adam. Yeah, so as you mentioned, I'm a startup lawyer, and I'm mainly focused on corporate and securities work. And the securities work is where we really get into the DSO work. So I'm a partner at Full Blockchain Law, which is a Philadelphia-based boutique firm. And that's really what we do. We work with startups and investors on corporate and securities matters. Our clients operate in a host of different industries, from online gaming and gambling to biotech and real estate. So we get a good dose of a lot of different industries and a lot of different perspectives from issuers or soon-to-be issuers who are looking to raise money. And it's just been the past 2 years have really been a blast in working with entrepreneurs and investors on this stuff, because it's cutting edge, and we're amongst the early movers and early adopters in this technology. So we've been fortunate enough to do about 360 million in digital securities offerings over that time. The firm was also selected by the EU Commission to study the interoperability of blockchain. So it was a pleasure to work with other firms in the EU to bring that study and just help educate people on blockchain technology, and especially regulators who are looking to learn more about this technology and how it can be adopted for how smart contracts and blockchain can be adopted for various different industries. And we work with token platforms, issuers, investors. So we've kind of seen all angles of digital securities offering in our experience. And of course, I have to have the legal disclaimer at the bottom, which says none of that's pretty obvious from the nature of the content here that you'll gather. So let's dive into it. We're going to talk about a few problems with traditional financing methods, and Jordan definitely touched on these. The digital security solution, and we have a case study of a digital offering that we did previously. So first of all, what is a digital security? I won't go over this too much because Jordan did a very nice job giving us a primer on everything that's involved with a digital security. But essentially, it's a security. It's going to be regulated by the same laws as a traditional security, as if you were issuing paper stock, but there are some nuances to it as far as privacy and how it's going to be traded and how it's going to operate once you issue that security. So here is a screenshot from one of the secondary trading issuers. Jordan mentioned that one of the key characteristics is the liquidity that you will be afforded when you issue a digital security. So what everyone's really excited about is the fact that once the holding periods are lifted, so your securities laws are going to govern, how long that security needs to be held by your initial investors. And then after that time period after that restriction is lifted, they're going to be able to go out and sell that security. The problem traditionally is that it's very difficult to go out and sell a security to someone because there is just very few marketplaces. So now that we have these marketplaces coming into the fray, there's going to be a lot more opportunities for people to go out and sell their securities and trade even illiquid assets, because now we have something that is liquid by its very nature, even if it represents an underlying illiquid asset. So some of the problems in traditional real estate financing include, higher costs, centralized organization. So with centralized operations, they're vulnerable to fraud and human error. So one example of that is there was actually analyzed a few years ago, there was a Delaware court case that showed evidence issues with traditional voting in the context of a merger. And there was a case where a stockholder outsourced the task of voting by proxy to a third party, which can be pretty common. And so the third party computerized the default instructions and was pretty much sending out these instructions anytime there was a vote. In this case, on this particular matter, the third party wanted to change those instructions, the stockholder wanted to change those voting instructions. The third party made the edits. The vote was postponed 3 times. And on the third time, someone failed to make the edit to the vote, and the vote went in the opposite direction of the stockholder's decision, which obviously caused a whole host of issues, caused litigation. And once you're in litigation, your costs can be enormous, and not to mention the headache that it can cause. So that's just one example of how blockchain, when you're using a distributed ledger and you're sending notices and transmitting information through the blockchain, as opposed to through people and intermediaries, it can just solve a whole host of problems and save you time and money down the road. Your due diligence burdens. So your due diligence burdens are not going to completely go away when you do a DSO. Obviously, you're going to need to collect a lot of information on whatever you are tokenizing, whether that's a share in a fund or a share in a hard asset, a real estate asset, or whether it's just shares of your startup. You're going to need to provide a lot of information that is going to go into your offering materials to ensure that you're complying with securities laws. But what it does solve is kind of that transaction of information between a lot of parties. So especially in a debt financing of a real estate transaction, there can be a lot of due diligence burdens, a lot of back and forth. Essentially, when you are conducting a DSO, you're gathering all that information up front, and it's almost like it's hopefully a one and done situation where once you compile it and send it out in your PPM, everything is taken care of. And less liquidity. So we touched on that. These assets are less attractive if investors cannot exit easily. So most people are going to, sometime, depending on the investment, obviously, you can take a real haircut on your exit if your asset is illiquid and you have, a life event or something, or you just want to exit your investment. If there's no liquidity, that's a real problem. So blockchain is looking to solve that issue amongst others. I think I've gone over this kind of in my comments on my last slide, but maybe I got a little bit ahead of myself. But so you have lower startup and operational costs, liquidity, ease of administration really comes from being able to manage all of your shareholders and your cap table using blockchain technology, sending notices to all of your investors you can see the real-time ownership stats live at any time, since the blockchain, as Jordan mentioned, never shuts down. It's always live. And then you have access to a global investor pool. So whereas before you might have had to sold your securities to people you knew, or a close tight-knit network, now with these platforms, once the securities restrictions are lifted, essentially, in many cases, you'll be able to trade with a global pool of people, which is a really exciting opportunity. And then another great option is that, when you have these real estate investments, sometimes you have one or two big investors that might come in, and they're going to dictate the terms of your transactions, or at least some of them. They might trust you as the principal or the sponsor, but they're still going to have a say sometimes on major decisions. But with crowdfunding solutions, you can really be in charge of your assets that you're managing, and you won't have to deal with one or two big heavy hitters all the time. And then we have regulatory certainty. I don't get this question as much as I used to, but people used to ask me if STOs were legal. And the great thing about them is, they're not ICOs, which were essentially illegal securities offerings. They are compliant securities offerings. So that's why they're called security token offerings. So very similar to an ICO from a technological perspective, but very different in the fact that you're making sure that you're complying with all the various securities laws. And we're going to touch on a few of those in my later slides. So to go over the life cycle of a DSO, you really have four primary stages. The initial stage is your entity formation and your tax advising. So this is where you're reaching out to your counselors and your advisors regarding how you're going to structure your offering, what type of companies you're going to need to be setting up, whether you're investing or creating a fund, and the different types of funds that might go along with that. That usually takes about 2 to 4 weeks. Then once you settle on a structure, you conduct your due diligence, your counselors conduct their due diligence, and you prepare all of the offering materials. So that's your private placement memorandum, your subscription agreement, and those are really the core documents to the transaction, because that's what brings this that's what takes us from an ICO to an STO, something that's compliant with securities laws, because you're giving the necessary disclosures to your investors, in addition to doing your KYC and AML checks, your know your customer and anti-money laundering checks on any potential investors that should be restricted from participating in the offering. And that's really a function of your token issuance platform. And so that's one of the roles that they play in this offering. So that'll take about 2 to 4 weeks, depending on how long it takes, the issuer to get all of the information gathered. And then you have your offering, which can be, it says 6 to 8 weeks, and that's, I guess, a good average, maybe a little even speedy, but it really depends on how quickly investors jump to fill the raise, because that can stretch out, a couple months, depending on what the investment appetite looks like at that time. And then you receive funding and issue the securities, and that's immediate. So once your token is created, which happens really in the document preparation phase, while your lawyers are working on your documents, the token issuer is getting that token ready and hard coding any securities restrictions that are going to be applicable to that token. So some of the considerations that we walk through when we are structuring a digital securities offering, we think about debt versus equity and the different implications that might have. So when you're constructing an offering that is going to be a hybrid, that has its own strategies and reasons for that. And it's primarily tax-based and depends on your investor pool. So all of these things that I mentioned in here, taxes, investor pool, and securities regulations, they're really interconnected. And sometimes one is going to dictate the other. So if you're raising money for real estate investments in the US, you are going to worry about certain taxes if you are accepting investment from Real Property Tax Act, which makes it difficult or disadvantageous for foreign investors to invest directly into U.S. real estate. So then you might look at some tax neutral jurisdictions for organizing and structuring your entities. And so your investor pool is really what's going to dictate this mostly. You know, that might be the primary consideration, and then taxes, or they might be neck and neck. But it's really all about where your investor is going to come from, because those are the securities laws that you're going to need to comply with. If you're offering in the United States and you're organized in the United States, but you also want to offer to investors in Mexico, which is what happened in a recent real estate transaction or real estate fund that we developed. They wanted to form the company in the US, conduct a US offering, but also offer to investors who resided in Mexico. Well, you're going to have to comply with the private placement and securities laws in Mexico as well. So all of these considerations are interrelated and kind of work in tandem with each other. And then you have your marketing rules, which I almost didn't mention. So your offering advertisements are going to be heavily regulated. So really the SEC is looking for, are you making any omissions or material misstatements in your offering materials or in your advertisements if you are advertising to investors. And so this is the most text I will have on any slide. Sorry about this, but when you're getting into statutes, it can be a little text. It's always text heavy, let's face it. So these are the regulatory considerations that we bump up against when we are dealing with a digital securities offering. So the primary statute being the Securities Act of 1933, and that act requires every securities offering to be registered unless an exemption exists. And the most popular of those exemptions is 506C, because it allows you to generally solicit and advertise your offering. There's other options like Reg CF, Reg A, but so Reg CF is pretty limited because of the restriction on how much you can raise, which is 1.7 million. And Reg A can be a bit of an expensive endeavor. It's almost like a mini public offering. But there are companies that have done those offerings on the blockchain. I think YouNow and Blockstack are two of the more recent Reg A, or two of the original Reg A offerings that were passed on by the SEC and approved by the SEC. So under that Securities Act, there's also going to be investor limitations and public reporting requirements. So even if you're complying with one of these exemptions, you need to ensure that you're not going over 2,000 investors who are accredited, or 500 persons who are not accredited investors. So there's other restrictions, even if you are complying with these exemptions. And then, as I mentioned before, there's the anti-fraud provisions, which really governs your statements to potential investors and your advertisements. The Investment Company Act of 1940 comes up if you are conducting a digital securities offering for a fund. So there's going to be restrictions and limitations that are imposed on the issuer depending on what their activities are. So if they're considered as investing in securities, then they're going to be regulated and subject to this act. But there are exemptions. So investments in real estate interests in a limited partnership or an LLC, or directly owning real estate, does not constitute securities. So that's one safe haven for persons who are trying to issue but do not want to comply with the reporting requirements that are implicated by this act. And then similarly, in the same vein, Investment Advisors Act of 1940 governs individuals who are running a fund that would be regulated under the Investment Company Act. And there's exemptions under that too. So really, you're not going to come across those reporting requirements unless you're advising a fund that has $100 million in assets or more. So the typical parties to a DSO offering are a token issuer. And then, like I said, they collect your investment from your investors. They conduct your KYC and AML checks. They conduct your accredited checks to ensure that your investors actually have the net worth that they say they do. And then they help execute the offering documents. And then another thing they don't do that I should have added in here was that they I think I mentioned this though, they code the token so that any restrictions that are required under the securities laws are hard coded in that token. So if you're not allowed to trade that token for 1 year to another US investor, you're not going to be able to trade that token through the platform or through the Ethereum blockchain. So your investors, obviously, probably the most important part of this whole process, because who needs all of this without the money from the investors? And then you have your legal team and your tax advisors preparing the offering documents, ensuring that you're complying with the laws that we just discussed. And then kind of your a la carte third parties who may or may not be involved. An escrow agent is sometimes required if you're going to have a minimum offering amount. You may want to engage your broker dealer to ensure that your raise gets filled. And then you may want to hire a marketing team if you're going to be generally advertising and you're not sure whether your broker dealer is going to be able to fill your raise or whether you just maybe want to go at it alone and try marketing it yourself. So this is a case study that we prepared, and this isn't just hypothetical. This is something we actually worked on. And this was stage one of a $75 million offering for a golf course and resort that is down in the Dominican Republic. So as you can see, it's a really beautiful site, and they had a really great success in the first stage of their offering. And so it's a real estate out in the Caribbean, and what people were able to purchase is interest in a holding company that owned these properties. So, we listed out the properties. There were several villas and apartments available, and there were actually also cottages and villas, and there was actually a citizenship by investment opportunity. And this is kind of a side perk, and you'll see a lot of offerings, especially Reg CF offerings. If you go on those offering platforms, you'll see that there's sometimes perks associated with these investments. Like if you invest, a certain level, you'll get, at Reg CF, it's sometimes like a t-shirt or something, or you'll get your name listed somewhere. But with this investment, it was really cool because you were able to get citizenship by investing in the offering. So the Dominican Republic has an opportunity or a law where if you invest at least $200,000, you can get citizenship there, and it gives you all kinds of tax breaks. So that was a really neat twist on this, which I think enticed some investors at least. But usually when we're dealing with these offerings, the primary motivation is to raise money and buy an asset. But in this case, it was kind of the reverse, because the issuer actually already owned the properties, and it was several persons who owned the properties. And what they wanted to do, they wanted to put all the properties together under one roof, and they wanted some liquidity. So it was a perfect opportunity for them to divest themselves of some of their assets, some liquid assets, all in one shot. And it was really beneficial to the purchasers and the investors too, because now they have an asset that is liquid as well.
All right. And Tyler, I see you're almost at the end here, but got some good questions coming through here. So want to make sure we have time to answer those.
Yeah, this is my last slide. I'll wrap it up. So it was only open to qualified purchasers, and they purchased, it was in the Dominican Republic. It really optimized real estate tax and residency incentives for potential investors. And, all the benefits that we talked about before, like real-time cap table management and, the benefit of using blockchain to send out your notices and manage your investor pool, they get all those, obviously. They're looking forward to doing stage 2 and stage 3, I think, in the coming months. So since stage 1 was a success, and that's an example where it was very early on in the digital securities market, and people weren't sure how big the investor appetite was. I know that we had a client who was considering doing an STO or a DSO for a biotech product. And the biotech market, investors really know, they're very savvy on how you make money in that market, and it's a very specific trajectory. And so there was really no need to inject a token in that situation, because there was a very specific process to how they get in and how they get out of their investments. And it didn't really make a whole lot of sense. So this isn't to say that a DSO is for everyone, but in this case, they wanted to test the market. And so they only tokenized, a portion of the properties at the golf course and the resort. And now they're looking at stage 2. Since stage 1 was a great success, they're looking at stage 2 and stage 3. And that's all I have for you guys.
Thank you, Tyler. Guys, we'll make sure we get Tyler's information in the chat box as well. If you want to screenshot it right now, go ahead and do that. Tyler at bullblockchainlaw.com. Great presentation. Happy that we were the first ones to see that. But diving into questions now, Tyler, the first one we had come in from Mo, which is AML/KYC occur at the offering stage, but are AML and KYC needed once the tokens trade on the secondary market?
So typically that's going to be an upfront compliance requirement from either the token issuer or the secondary market where the investor is going to be repurchasing the token. So it really absolves the issuer of that task and having to take on any liability for compliance with KYC and AML. So it happens at both stages, but it just might be a different party that's handling it. So wherever the investor is purchasing the token, that's going to be the platform that's going to handle the KYC and AML. But it doesn't have to happen every time you make a purchase. It just happens initially.
Perfect. And then actually, you know what? You can stop sharing your screen now, Tyler, too, so we can see you when you speak. All right. Thank you. Next question's from Daniela. Have you dealt with real estate transactions using a digital twin of a development or selling a virtual land along with the corresponding parcel in real life?
We have not, no. And we've seen these digital lands being advertised and marketed, and they're really interesting opportunities, but we have not done a DSO specifically for digital land or digital land with associated real land. But I'd be interested to hear about any deals that people are looking to do with that.
All right. And from our buddy Sam, did La Estancia use a broker dealer for their offering?
They did not, no. So they were able to advertise it through their network, and it was kind of a word of mouth. I think there was a lot of excitement from a core group of initial investors that they had lined up, and then the excitement kind of took over. It kind of did the job for them because there were investors it was kind of like a ripple effect. So the investors that initially invested, it was a word of mouth kind of investment almost.
Yeah, I guess I have a question too. Is there any other projects that I guess you've worked on similar to that golf course one, or was that kind of the first of the only one so far?
So similar in that, there's other DSO real estate offerings, yes, but each one we've done is kind of unique. So the one we are working on for a client, like I mentioned, the fund. So that's kind of a mixed bag of a DSO because there's a real estate investment, but there's also investment in securities and private companies in Mexico. So they're investing in real estate, but also renewable energy and mining. So they have a base metal mine down in Mexico. And so it's kind of like a 3-tiered investment. And we're also working on a debt offering for a group in Hong Kong that actually has a logistics facility. And so they're going to automate this logistics facility so that it cuts a lot of costs, and it's going to be used for import exports. And so it's kind of a unique opportunity for a debt offering that we're working on.
Cool. Tyler, does your firm have their own STO platform at this time? And if yes, did you build your own platform, or is it a third-party platform that's been white labeled, or even just as a SAS product?
I wish we did. We don't. We work closely with a couple different issuers. Securitize is one that we work with. They're great over there. There's other platforms. I think Vertalo is doing a lot in the real estate space, and they have a group based in Philadelphia as well. So there's a couple different platforms that are doing really good work that we enjoy working with. So
I noticed you said Securitize. Would you say they're probably your number one recommendation, or where else can people go to get more information on who to work with? That's kind of tying into Ryan Poole's question. Ryan, I see you asked right there.
Right. Yeah. They're a really good platform to use. They've been in the game since the beginning, and I think that they've done the most offerings of any platform. So they have a really good team over there that knows what they're doing with this stuff, and they've just recently gotten their transfer agent license. So there's some licensing requirements that also comes with being a platform. They're not just out there writing code and issuing these tokens. They're also kind of managing the cap tables and the ownership and the dividend payments. And so there's a lot of responsibility there to get things right. And, they've gone through the proper protocols to get their licensing and ensure that they're complying with all the laws. So they're a great outfit.
And Adam, if I could just jump in, we've done a lot of investigation on the larger platforms out there. And Jordan is going to be putting together something on that, a little bit of a comparison in an article later on this year. So just to kind of, show who's offering what and, how all the pieces put together.
Thanks, Michael.
I just put Jordan on the spot because he didn't volunteer for that article.
All right, I got my pen and paper right here. I'll get started.
Thank you, Jordan. Thank you, Michael. Guys, we got a couple more minutes here. Anyone has another question for Jordan or Tyler? We'll just leave the floor open. Feel free to unmute yourself. If you can't speak, feel free to type. But we'll sit here for a few more moments and then call it a day.
I'd like to ask a question. Tyler, where do you, I guess, where do you see the future as time frame is for STOs and the secondary trading? I mean, what kind of time frame do you see out there? I mean, we all know about cryptocurrencies and how much that exploded, but where do you see a vision you see for the STOs and secondary trading? How far along on the legal side until it becomes, closer to mass adoption?
Yeah, it's tough because it's really dependent on when all of these companies get their restrictions lifted on their securities. So, we're just now seeing, and in the past couple months, seeing the first DSOs that are getting their restrictions on secondary trading lifted. So typically it's a 1-year restriction for anyone who doesn't know. When you purchase the token to the time that you can trade it, at least if you're a US investor. And so what happened initially is there were a couple DSOs, but really we're not seeing the secondary marketplace activity and liquidity yet because those restrictions are just now maturing. And so I'm thinking, it ramped up last year, towards the end of last year, as far as people diving into the space and wanting to conduct these DSOs. And so I think, maybe we're like 8 to 12 months out from seeing a lot more activity and liquidity in the space.
Yeah, Tyler, and if you don't mind, I'll kind of do my plug here. It's really interesting to watch from an international market perspective how much movement's been in these DSOs and STOs, and how much really the liquidity was coming from. More oftentimes than not, I should say, international markets tend to be a little bit ahead of us because the US comes in with some compliance features, which is a good thing. And that's what, makes, our markets, that much better. But nor here nor there. There are, I want to say, oh my gosh, there's got to be 15 to 20 secondary exchanges that offer this type of liquidity. Now, let's not forget that it's not just, you're not trading on just one platform, right? You're not just trading on the New York Stock Exchange or the NASDAQ. You're trading on Open Finance, you're trading on a T0, you're trading on this, that, whatever. There's a lot of different exchanges where, these tokens can be traded. And the cool part about it is this buzzword we like to use is interoperability. And what's also nice about that is these tokens have the characteristics and, using the blockchain technology to be able to do just that and trade on multiple exchanges at one time.
Yeah, couldn't agree more. And, now there are starting to more and more secondary platforms are starting to come into the fray, but before it was just a few key players, and as one of the reasons why you should go with certain token issuers is because maybe they have more leverage with a secondary platform and can get your token listed for secondary trading, which is what a lot of people are looking for. So, it'll be interesting to see if that still remains as a primary consideration when there's more and more players coming into the space to list these tokens.
Michael, did you have something you wanted to share?
No, I'm good. Thank you.
All right.
Really appreciate both Tyler and Jordan and you, running with this. It was really informative.
Thank you for bringing us all together, guys. I put Tyler and Jordan's emails in the chat box there, so if you want to copy and paste that one more time, you can. There will be a replay video of this uploaded with contact information as well. And if you're not already a part of the meetup group, a link to that will also be in the description. Feel free to join us in the next meetup, which will be on Thursday, July 9th. Guys, this one has been a blast. Jordan, Tyler, I'll give you a couple moments here to say thank you. I'll start with Jordan.
Yeah, thanks again, everyone. I think, some of the major takeaways with this is, yes, this is new, but, we're just scratching the surface of the benefits that could come out of this, right? Not only is it liquidity, but it's the fractional ownership, it's the transparency, it's the automated compliance and governance that really, are the key drivers to what really I think is going to be the future of financial services.
Yeah, I couldn't agree more. Thank you guys for having me. It was great speaking on this, and it's a pleasure to be introduced to this group. So I'm looking forward to seeing more events that come out of here and attending.
Perfect. Thank you, guys, and we will see you on July 9th. Thanks.